A lot of oil and gas sponsors weaponize the fact that you don't know anything about oil and gas against you. Meaning, they'll tell you, we don't have any management fees, yet they're charging cost plus. If a well costs $1 million, they're marking that well up to $1.6 million. If they don't have a slide that shows sensitivity economics, another red flag.
What part of passive investing in oil and gas needs to die?
I'll give you a different one. The Facebook ad.
Investors and operators, welcome back to the Invest Clearly podcast. I'm your host and CEO of Invest Clearly, Pat Zingarello. In today's episode, we sit down with Michael, an oil and gas LP and co-founder of Sandstone Group. Michael shares how he evaluates working interest opportunities versus mineral rights and what lease structures and operator terms catch his attention. We also discuss production decline curves, break-even timelines, and why he prioritizes cash flow over just tax benefits when investing in drilling programs. Let's get into it. The views expressed in this podcast are those of the individual guests and do not reflect the opinions or recommendations of Invest Clearly. This podcast is for informational purposes only and should not be considered investment advice. The appearance of a sponsor or investor on this show does not constitute an endorsement or a warning. Invest Clearly is an objective and neutral platform. Always do your own due diligence before making any investment decisions. Mike, thank you very much for joining me today. Before we jump into it, why don't we take like 30 seconds, tell us a little bit about your background in Sandstone, and we can get into it.
Absolutely, Pat. No, really excited to be on here. Appreciate the opportunity.
Yeah.
The short version of my background is I work in oil and gas. Started out as an engineer, moved to the dark side of finance, as everybody tells me, about halfway through my career, and really cut my chops working in and around different oil and gas syndications, which, to be honest, before I got into the business, I had no idea that what a syndication was, or even that oil and gas used that model. I figured it was exclusively for real estate and other kind of alternative investments. Found out there's a huge market of oil and gas companies that raise capital through that syndicated market. So really cut my chops on the finance side of the business. About 4 or 5 years ago, broke out and just kind of started my own little small oil and gas consulting firm, mainly, running A&D, helping with mergers and acquisitions on the small side. And then about 3 years ago, we started and opened up a small private oil and gas asset management company where we just invest our own private money in various oil and gas deals.
Awesome. Very cool. Awesome. So I would love to kind of focus on your LP background and then get more into how what you're maybe seeing some trends in the O&G space. What's interesting is, I've said this on a bunch of podcasts, more and more LPs are bringing up oil and gas to me. So like, in the essence of trust and transparency, what are some red flags you look out for in the O&G space when you are making these LP investments? And then are there any very hyper-specific points in your due diligence that you look for before you make an investment?
A great question. I would say, to answer the first part of your question, if a sponsor can't clearly explain how they get paid, it always throws up a red flag on my end, because one of the things that I've found, and I'm an industry insider, so I have a little bit of a unique perspective when I go to specifically invest in the oil and gas space, but for non-oil and gas folks, and I say this generally, a lot of oil and gas sponsors weaponize the fact that you don't know anything about oil and gas against you. Meaning, they'll tell you, we don't have any management fees, yet they're charging cost plus from if a well costs $1 million, they're marking that well up to $1.6 million. But we don't have any fees, but it's cost plus, and they're very particular about their words. So one of the first things I always look for in marketing material or a PPM, or if I'm just talking with somebody who's trying to pitch me an off-market deal, which is, I would say, the majority of the investments that we make are sort of just off-market, what I would call direct working interest deals. If I ask them, what's your fee structure or how do you get compensated? If they dance around that, if they can't clearly say, oh, well, we charge a X% fee and we have a little bit of carried interest on the back end, or we're charging cost plus, if they're really coy about that stuff, to me, that's a red flag, because that means that, to be honest, they're looking to slip by around that standpoint. A lot of people invest in oil and gas specifically from a non-industry background. They do so because of the tax deductions, and I'm sure that's how 90% of people who aren't in oil and gas get exposed to oil and gas, because of the tremendous tax benefits, and they're amazing, to be honest with you. And a lot of people use those tax benefits as like, well, don't look at my massive fees I'm charging. I'm saving you, 50% a year on taxes, and do it that way. Some big red flags I look for. Track record, I would say, is not necessarily like years in business. I can tell you there are companies that have been around in business for 30 years that have a terrible track record. And there are companies that have been around for 2 years who've only done 3 funds who have a tremendous track record. So when I say track record, I really think about pedigree. Are you an oil and gas expert? Are you somebody who has worked in oil and gas and then decided they wanted to go, build a company and need financing for that? Is really how I look at it. I don't necessarily look for somebody who, honestly used to be a salesman, realized that, there's this big burgeoning business of oil and gas syndications where I can sprinkle tax deductions over unwitting LPs to raise a little bit of capital, charge an enormous amount of fees, and call myself Billy Bob Thornton from Landman. So, which is truly how some of it is. So it's more not track record per se. I say pedigree, and I could go through a litany of examples, which we won't do that right now, of people use their 30 years in business to mask the fact that they haven't necessarily had the greatest track record, and people who have been in business, say less than 2 years, but have done multiple successful kind of micro funds and have been highly successful at them. It's because they come from a pedigree of understanding the oil and gas business.
Very, very interesting. I mean, this is an area that I don't know much about. I don't know much about this industry. I hear a lot of, and I usually don't go down like the tactical and strategic path on some of these calls, but like I'm oddly curious. I hear people talk about wells and then mineral rights. Like, is there a difference between those, or like what should people be looking for when investing in this asset class? Like, should they be focused on people drilling? I don't even know if that's the right question.
No, it's a great question. And it all comes back to, what are you looking to get out of the investment? So there are some times when I'm, for me being an oil and gas insider, my primary motivation is cash flow. Yeah. And there are a cash flow plus some sort of multiple or return on my investment over a really nice opportunity, or time frame, I really should say. And so my bias preference is to, if somebody is hard selling me tax deductions, I'm not interested. Yes, I have a tax problem on some level in my business, but that's not my primary motivation. And so really the reason why I bring up tax deductions is because that's the main reason people get introduced to oil and gas. And they get introduced to oil and gas because the tax deductions, and this is important, so I'm going to explain it real quick and then answer your question. Yeah. Where the tax deduction in oil and gas comes into play is what's known as the intangible drilling cost deduction, which basically means anything intangible in drilling a new oil and gas well, labor, rig time, anything that's truly, as a CPA would say, non-salvageable, you can 100% write that off as both the oil and gas operator, and then if they have investors or general partners or it's part of a fund, can flow back to the LPs in that process. So it generally works out to, when you drill a new well, about 80% of the costs qualify for this IDC deduction, which means you could theoretically write off up to 80% of the investment. So when people hear tax deductions, think they're drilling oil and gas wells. And that's, as you intimately brought up, is one way that people can invest in oil and gas, is you can find a project in which they're drilling wells. And the process of drilling oil and gas wells, when I was an engineer, I was the fancy term, it was called reservoir engineering, where it's the idea of predicting how much an individual oil and gas well is going to produce. It's a science. It's honestly also a little bit of an art. If your first 2 years in your career, you're just hope you're working at a big company and saying, hey, this is what my projection is. What do you think? And someone with a lot more experience who has seen a lot more wells get drilled say, interesting. I like that. Here's what you forgot. Boom, boom, boom. And it also varies by region. If you're investing in the Permian Basin, if you're going straight, landman style, I bring that up only because people have seen the show. It's an easy way to say. That is the way you would evaluate that oil and gas well is different than, for example, I've got a large investment in a shallow vertical company that's here just about an hour and a half away from where I'm sitting. They're drilling 1,900-foot wells that produce 10 to 15 barrels a day. That doesn't sound sexy, but at the end of the day, how much it costs to drill versus how much you produce, that's where your alpha is. It's, I try not to make crude real estate jokes, or not jokes, but analogies, because I, like you and oil and gas, I know nothing about real estate. I know just enough to be deadly. I know just enough that I've been burned on 2 short-term rentals, but that's beside the point. And so there's that avenue. And so if you're interested in a tax deduction, and that's why you get intro to oil and gas, that's where you would sort of fall into the oil and gas, like drilling a well, which is you're gonna invest in a well that's being drilled. You're going to either be investing via a fund where the fund owns the well and then you own an interest in the fund or the partnership, or you're investing directly in the well, which the technical term is you're buying working interest or buying non-operated working interest because it's a passive investment. You can also think of it as you're just buying equity in an individual well. So I'm buying 5% of this oil well, which means you're entitled to 5% of the revenues that come from the well, but you're also responsible for 5% of the operating expenditures. And assuming the revenue is greater than the OPEX, then you make the net there. Yeah. Mineral rights are a little bit different because there's no drilling involved. And all you're doing is actually owning the minerals. So to take a step back, if me and you are an oil and gas company, we want to go drill a well right outside my apartment. Well, we don't own the land, and we don't also own the minerals underneath it. You think of the minerals as everything below surface. We have to lease those minerals from the owner. And the owner of those minerals might say, great, I'll lease you 75% of the minerals, and I'm going to retain a 25% interest in the minerals. Meaning us as the oil and gas operator, if a well cost $1 million, we have to pay $1 million to drill the well. But if in the first year, let's just say for easy numbers, this is not how it happens, but for easy numbers, $1 million of revenue comes off the well. Well, we only are entitled to $750,000 of that. The mineral owner gets $250,000 of that, and then we owe 100% of the expenses. So if the expenses were $250,000, now all of a sudden on the year we've netted $500,000 of profit, and then we go share that with whoever are the other working interests. So the mineral owners are the true people that actually own the minerals underneath. And so what a mineral rights deal, or if you purchase mineral rights, or you're investing in a fund that buys mineral rights, which I have done a lot, and it's really interesting, is you're actually going out and buying the minerals from the mineral owner, and then basically you are entitled to X percentage of top line revenue that comes off the top. It can be at a 25% mineral interest. It could be at a 20% mineral interest. It really depends on the location. Now, both have pros and cons. If you're drilling a new well and investing in a well that's being drilled, well, you know they're actually going to drill a well. The one thing to know about oil and gas is every single well that gets drilled declines over time. It's why one of the tax deductions in oil and gas is called depletion, because you're depleting the reservoir. So the most amount of oil you'll get is in the first 6 months of production, and it'll slowly decline from there. So same thing in a minerals deal. You're just, you're just subjugated to whatever the production is. The difference between minerals and wells is, I can really sum up as the following. Do you like control or do you not like control? On minerals, you can't control if we drill or not. If me and you decide to go drill that piece of property outside my apartment right here, and the mineral owner sells it to us, and then we don't drill it for 2 years, well, guess what? That owner gets no revenue because we've decided not to drill. It's not up to the mineral owner whether or not something gets drilled. Now, if it does get drilled, you're entitled to basically a cost-free royalty on top of just 25% of the top line revenue. But on a well side, we can control. If me and you decide and are the operator or invested in non-op working interest, you know that this well is going to be drilled. So the opportunity to get revenue goes up, but there's also a little bit more risk involved because if anybody tells you they know what an oil and gas well is going to produce, they're lying to you or they're not being honest with you because there's always a range. So that's really the difference.
That's really, really interesting. Thank you very much. This episode of the Invest Clearly podcast is brought to you by Scale IR. If you're raising capital, you know the hardest part isn't just generating leads. It's turning those leads into committed investors. That's where Scale IR comes in. Scale IR transforms your investor engagement process with their proven solutions that optimize lead qualification, accelerate investor conversations, and drive higher conversions. From seamless CRM integration and intelligent workflows to expert investor qualification specialists who handle your initial discovery calls, Scale IR gives your team freedom to focus on closing deals. If you're ready to scale your investor relations and capital raising effectiveness, visit scaleir.com to learn more and book your strategy call today. Scale IR. Engage smarter, convert faster. And it's funny, you could see the passion coming out of you in this, so it's awesome to hear it from someone like you. Now, for people that are getting more into oil and gas from real estate, and your experience as an LP and even in your advisory role, what are you seeing in terms of trends, maybe opportunity flow, maybe new entrants into the market from 2-3 years ago to now? Are you seeing a big difference from between those two time frames? Like, for example, a lot of people are in the multifamily space are cash flow and deals are tight right now, right? Because of interest rates and all of that. Like, are any trends like that happening in the O&G world?
I think you hit the nail on the head. I think the reason why you're hearing a lot about people talk about oil and gas and why oil and gas has become such a big topic within the real estate community, I think over the past 4 or 5 years, is exactly what you pointed to, interest rates. So let's go back to when interest rates really started going up, which was end of 2021 into 2022. Well, what were oil and gas prices? Because at the end of the day, oil and gas prices drive returns. People are also interested in oil and gas because if oil goes to 100, I'm going to be a millionaire. And so if you look at what was going on at that time frame, as interest rates began to creep up and it became harder and harder to underwrite multifamily deals, oil was at 75, 80, was at $85, which is a really attractive price when it comes to when it comes to underwriting oil and gas deals. It unlocks a lot of areas that we could drill at higher prices. And one of the fallacies that we talk about is, we're running out of oil and gas. Oh, no, we're not running out of oil and gas. We're running out of oil and gas that we can drill at $60 oil. But if oil goes to 100, there's plenty of oil to go around. Now, we don't necessarily want that. That's not great for the economy. My background's also an economist, so we could get into all that sort of stuff in a different conversation if we wanted to. But point of the matter is, there was this really arbitrage opportunity between real estate going up and not being hard to underwrite deals, and oil and gas having extremely attractive cash flow metrics due to high oil prices. And then when you layer in the tax deductions, which in my opinion are superior to real estate, just due to the fact that if you're investing in projects that drill oil wells, I'm completely convinced there's no better tax efficient vehicle that also provides cash flow than oil and gas. You could obviously go invest and do charitable deductions. You could go do other things that maybe have a slightly higher tax deduction, but don't provide cash flow. So if we're talking about the group of, diversification, cash flow, and tax deductions, in my opinion, oil and gas wins. So that's, I think, where the shift really happened, where was people saw that arbitrage. Now, I think what's happening right now, honestly, is oil prices have dipped a little bit. And I think a lot of these funds or these projects in oil and gas that haven't seen the test of time, I've been in the business now like 12 years, which is not that long, but I've seen like 4 downturns. And that's just what happens in this space. It's a cyclical business. And so I think what you're seeing is a lot of funds who haven't gone through a cycle yet get spun up and got spun up in 2021, 2022, 2023 because they saw this arbitrage opportunity and now we're dealing with the first downturn and they probably got into projects that worked at $75, $80 oil, underwrote it with that, didn't necessarily stress test their models at all, didn't necessarily think, what happens if this drops, and structured their deals in a way that now maybe at $65 oil don't necessarily make sense. Trust me, there are still profitable wells to drill out there. The problem is Exxon and Chevron own all of them. They're not necessarily going to be available to me and you. Obviously, if we know somebody at Chevron, that's great. They might toss us a deal here or then. I mean, they won't, but point being, if you're an industry insider like myself, I sometimes get past deals that are in the core Midland Basin that aren't necessarily going to reach the open market from like a non-oil and gas folk standpoint. And those deals can make sense. But there's a lot of deals right now, specifically in the drilling space, that are becoming a lot more harder to underwrite at these prices. And I think that's where, in my opinion, what you're hearing today a lot more of is people pounding the table for tax deductions. We saw that with the One Big Beautiful Bill. Everybody is using that now as marketing material to their potential investor base and saying, look, the tax deductions are here to stay. And they're not really talking about the underlying cash flow metrics.
Sure. Okay. So diving more into that, you mentioned the arbitrage opportunity. Maybe someone wasn't effectively underwriting the risk with the oil prices. When an LP is shifting from real estate into oil and gas, what should they be looking for so they can effectively like protect themselves from an underwriting standpoint from that type of scenario? Right? It's not something I would think of, right? Like not something I would know in terms of how often there could be a downturn and how much economic policy would impact this. So like what should an LP look out for from like an underwriting standpoint in a scenario like that? Does that make sense? Did I ask that well?
It's a great question. Great question. I think the first thing is in the PPM or their summary deck, whatever they call it, marketing material. If they don't have a slide that shows sensitivity economics, another red flag. If they haven't gone and say, hey, we've stress tested our model down to $50 oil, and they're just saying, oh, we're giving you one scenario at $70 oil. Well, me and you both know oil prices aren't going to stay at $70 oil. Maybe it'll average $70 oil, but as I tell people because I get, I have a lot of friends and family who come to me and say, hey, someone's trying to sell me this oil and gas deal. Can you look at it? And that's also a service that we do here at Sandstone, is if people are interested in or someone's pitching them an oil and gas deal, we do a consultation where we read the PPM, and then we try to give non-biased thoughts, because there are a lot of good deals out there. I don't want to make it seem like there's a lot of bad deals out there. But if I knew where oil prices were going, I wouldn't be on this podcast. Love you, Pat, but I'd be on a beach somewhere, because I'd have gambled all my money in crude oil futures, and I'd be a billionaire right now, and I'd be hanging out in St. Bart's right now. So I don't know where prices are going. So if you're not giving me a view of at different price points, that is red flag me. And I don't know how, it's a little bit different than real estate, where in real estate, you generally are getting a fixed interest rate. So if you're able to get your loan at 5%, I don't know where interest rates are right now or where they'd be. I think they're a little bit higher. That makes sense. You don't need to vary that. Now, if it's a variable loan, then yes, I would want to see a sensitivity chart. But that's my big thing is making sure that they've underwrote the deal at multiple different oil prices, and then also don't over allocate yourself to the oil and gas space. Then, I mean, it's just like any portfolio that you have. In my opinion, no more than 5 to 10% should be allocated towards one investment. And that goes anywhere, whether you're investing in a hot dog stand. I'm a little bit on a soapbox now. We're not talking about oil and gas, maybe portfolio management, but don't overexpose yourself into something that you don't necessarily know about. Yeah, is 50,000, if you've got a 400,000 or looking to place 500,000 of capital in the next year, yeah, 50,000 maybe, that'd be a great number to invest in oil and gas. But if you're getting talked into 250, 300, in my opinion, wow, that deal could be great. Those deals are always going to be around, because trust me, those sponsors are going to have new deals that come up. And if this deal works out with this sponsor, they are more than happy to get you in and invest again. So don't over allocate yourself, and make sure that at the worst case scenario, the $50, $55 oil level, as long as you're comfortable with those returns or can stomach them, then go all for it, because the upside, if prices were to go up, is also tremendous.
Interesting. Very cool. And for the record, I used to own a hot dog stand. But that was a lifetime ago. So I was going to ask you if you did ever offer like a consultative service for LPs. It's really, really interesting. When you look at these and you conduct these, besides the sensitivity, numbers, is there anything you see LPs, or even on the advisory side of the Sandstone, that GPs are making? Like what trends do you see, or mistakes you see people making when underwriting these deals? Like, hey, someone comes to you for a consultation. It's like, this, I think this, and this. And you're like, okay, here's a whole area that you didn't even consider when looking at this deal.
So I mean, we could talk for hours about this, because there's always unique ways we see. One is because I'm in oil and gas, because I can go look up where these wells are being drilled. What I like to do for clients is, I'm just going to go run my own. I'm going to just build my own oil and gas model. I'm going to rebuild their model from scratch. And it sounds hard. It's not quick, but it doesn't take weeks. It's a day or two turnaround where say, okay, they're drilling right here. Let's just go see all the wells that are around there. Let's go in the PPM. Most of these PPMs are 400 pages long. Yeah. That's honestly another red flag to me. If you're a 400-page PPM, good luck. And I've actually been messing around with Gemini if you give me a PPM in PDF, uploading it and spit out 10 different things. Go search for it and find it. So honestly, AI, in my opinion, is going to expose a lot of these 1,000-page PPMs. But I try to just do a quick recreation of the economics. And an early sign that I have is, if I can't do that using the information that's in your PPM, you're being way too vague. You should tell me, if you're drilling an oil and gas well, you should tell me where you're drilling. I'd like to know what the lease number is. You don't have to, and I'd like to know where you think the upper and lower limits of your oil and gas well. Because any oil and gas project, it comes back to how much is an individual oil and gas well going to produce. If it's new drilling and there's no other wells around it, I'm going to apply a much higher risk factor. We used to talk about this when I worked at a large private equity oil and gas company. We would always run what's called risked economics, which means if And this is where the art comes in a little bit, because your geologist would tell you everything has risk to it, but they would assign a level of risk to it. If there's production all around you, that risk factor is maybe only 5 to 10%. If there's no production within that entire, within 5 miles of where they're drilling wells, well, the risk factor might be 50 to 60%. And so whatever the prediction for that oil and gas well is, we should then apply that risk factor. And if we still like what the results are, then maybe it's a worthwhile investment. So that's number one. I just try to kind of quickly recreate their model and see if I can back into their numbers. And if I can't, or it's hard to do, it's another red flag. Another thing that I look for is self-dealing. A lot of times the sponsors aren't the operators. And so then what I like to do is, because the PPM has to clearly lay this out, I then go say, okay, who are the operators? And half the time what you'll find is the sponsor is also the operator operating under another company, and they haven't necessarily made that clear, which means that operator is charging what we call a contract operator fee, meaning they're charging the sponsor, who's the management company. It's almost like a property management company, except the property management company is owned by the sponsor, but they're not telling you that the property management company is owned by us and we're charging you a fee to manage those properties. So yes, we don't charge management fees, but we charge an operator fee. This wording gets really different, and really the only reason I know this is I've sort of lived in this space and have kind of seen this done on both sides. So that's the other thing I look for. If there's a lot of self-dealing, I don't like that. If you're buying leases from a third-party entity that the sponsor also owns an interest in, well, now all of a sudden you're just buying a property from yourself. How do I know that you're not marking it up? All this sort of stuff. So those are the things I look for. And then again, can you clearly explain to me what you're going to do? I'm not a big fan of, I shouldn't say this. I'm more skeptical of what I would call blind pools. There are some deals where they say, hey, we're going to go out and buy oil and gas assets. Cool, which ones? We don't know. Okay, well, now I've got to evaluate the evaluators. Now there's no reason, now there's no model I can build, because your model is sort of just like this. Now I got to look back and evaluate the evaluator. And sometimes, and I've done investments like this where it's a blind pool, but the sponsors have a tremendous pedigree of sourcing oil and gas deals, have done it before, have a proven, hey, we maybe not done this in the syndicated market, but we've done this for private equity, and the investments have turned out tremendous right now. I'm in one right now that's excellent, and it's a blind pool. So I don't want to say don't avoid them, but understand that if they can't tell you where they're going to drill or where the mineral rights are, your mind should shift to not evaluating the deal, but evaluate the evaluators.
Awesome. Very cool. Okay, Mike, I know we're headed towards the end of the call, which is weird because it feels like it's only been about 30 seconds. On every one of these calls, I like to ask people the same question. We could really gear this towards O&G, and you may have already said yours about 30 times in this podcast, but what part of passive investing in oil and gas needs to die?
I'll give you a different one. The Facebook ad. I'm not against Facebook ads, but I have a knack for looking at Instagram and Facebook ads when they pop up for oil and gas, and 95% of them, I don't want to say are garbage. That would be unfair, but they're way too sensationalized. And I tell people this: if you get hit with a Facebook ad to invest in oil and gas, risk that economics 50%, because there's a lot of people looking to invest in oil and gas, and there's a lot of companies out there that are great that don't need to run a Facebook ad in order to get their attention and get different investors' attention. The best way, in my opinion, to hear about oil and gas is either through a friend who's done it, is through an investor community like yours, Pat, where you've had members who've invested in oil and gas, and they just are spreading the word. That's truly how the best opportunities are sourced, is they're sourced word of mouth. Because trust me, there's a lot of money to be made in oil and gas, and people love to talk about their successful investments. So that word of mouth gets around really quickly. So if you get hit with a Facebook ad for oil and gas, you probably won't become Billy Bob Thornton from Landman. You might, but it's a very, very small chance.
Good stuff. Thank you. Okay, Mike, before we go, we didn't get too far into it, but this is our LP series, but we do have GPs listening to this show to understand the mind of the LP. I'd love to hear a little bit more about Sandstone, and ultimately how to get in contact with you if you are an LP or a GP.
No, absolutely. So we are not a GP. We have a private asset management company that invests our own profits from Sandstone Group, which is a really interesting and unique business model. We probably do about 3 to 5 deals a year, depending on how profitable of a year we do, and then how much of a cash flow we decide to reinvest. But Sandstone Group, we're just a boutique oil and gas consulting, mainly dealing in the finance and acquisitions and divestiture space within the oil and gas. So we work with a variety of clients, whether they're syndicated or non-syndicated, just privately held oil and gas companies, to help them with all sorts of stuff. We do have a large, what I would say, kind of due diligence business where we help LPs who are interested in investing in oil and gas. We have multiple different levels. If you're looking to invest $50,000, we've got a very, very cheap package where we'll just give you a quick run through. If you're looking to allocate, $1 to $5 million, I would recommend you're going to want to pay a little bit for due diligence, and we have packages that kind of support that, where we work with geologists and we work with sort of everybody, a team that would be able to evaluate that deal like we would if we were just buying an oil and gas company. You'd want all these different people on your team. So we have packages that kind of fit all different levels of due diligence. And then obviously we do it privately ourselves. I would say if there's any oil and gas sponsors on this call looking at me, if you can't tell me what your fees are, and if I see you on a Facebook ad, it's going to be tough to get me. I might, but you're going to have to sell me really good.
Great stuff. And how do people get in contact with you?
Absolutely. You can find me on LinkedIn, Michael Tanner. You can go to sandstone-group.com. That pesky dash kills me, but we don't quite have sandstonegroup.com. And otherwise, I'm pretty all over the place. We have a YouTube channel for a podcast that we do. So I'm pretty easy to find. Just Michael Tanner, LinkedIn, sandstone-group.com. Really
Great
easy.
stuff. Mike, thank you so much for joining me. I really enjoyed this episode. I can't wait to get it out there.
Absolutely, Pat. Thanks very much.
Sure thing. Thanks for listening to the Invest Clearly podcast. To find verified investor reviews or to claim your GP profile, please visit investclearly.com. If you enjoyed this episode, please remember to like, subscribe, and leave a review, because that's how other people find this show. Till next time, invest clearly.